Hey, Jonathan, can you hear me? I see your hand is raised. Come on in. There you are. Twice. Can you hear me? Happy Tuesday, first Tuesday of the year. Not seeing you, unfortunately, so let's get that going on. Hello, hello. Sorry for the delay, folks. I'm just trying to get Jonathan in the room. I can see him, but I don't see his face. We'll see if this works.
How about now?
Ah, there you are. Happy New Year.
Happy New Year to you too.
You're back from your very exciting travels.
Yeah. Right? Hold on, let me get this all set up.
Yeah. Let's get you a little bit situated. Sorry for that. Not sure, but I was seeing double of you.
No, it's okay. It's okay. Hold on. All right, I think we're good to go.
All right. Well, Happy New Year, everyone. We are Tuesday, the guest captain interview series with Jonathan Gibbons of VigTech.io, and we've got lots to cover. We decided not to do kind of a year ahead, which may be a year ahead review, or look ahead, I should say, but more to the point of always talking market structure, volatility, and then what we see post-election Georgia runoff and such in the near term, because at least that much we can, kind of size up how the market is so far positioning. And then I'll switch it over to Jonathan. He's got some presentation material, or I should say, talk about the need for more active management in 2021, which I would say, especially with the goings on in SPACs and such, which are not so representative, might have some very good reason to actively manage positions. So just so you know, Joshua, another one came in named Joshua.
Oh yeah, you could just delete that. Yeah.
All right. I'm going to remove. There we go. All right. So where would you like to start?
We were talking about active and passive, right? Like that was one of the main things that we were talking about the other day, and I actually have put together some articles about that that are being kind of published, I guess you would say, because people were asking me about it recently, and I'm on this kind of belief, because we were talking about not making predictions in a price context or sheerly directional context for the next 12 months, as a lot of people want to try and do maybe at the beginning of the year or venture to do. And my whole thoughts about the active to passive are that we've had some significant years running, I guess you would say, of where the ETF environment grew and a passive indexation grew, and the active manager is just pretty much written off completely. It's not necessary anymore, right? Indexation takes care of it. And I think that is only, and this is my macro thesis kind of for the year, is that that's only applicable in an environment where it is conducive to the one time frame ETF rebalancing that works. So one time frames, if everybody can understand, is like every day, usually at the beginning and the end of the day, these ETFs, which have grown in nature because there's no need for active management or active position rebalancing of any kind, because there's no turmoil, right? And I know that that's a pretty blanket statement to make, but it seems pretty relative over the last 12 years. And it's a 12-year period where really most of the volatility has been taken out of the market. When the volatility is out of the market for a prolonged period of volatility, just these incremental periods are not necessarily the same. but a prolonged period of time where you don't have significant drawdowns or really any need for that to take place, then the active manager isn't a necessity, and then can be replaced with just a natural rebalancing algorithm or an indexation type situation. And I think that towards the last 2 years, you begin to see that change over a structure where we really have not, even in the last year, yeah, we were up. But if you look back to 2018 to now, it hasn't been a straight line of just gradual growth. It's been a very violent mess where it's almost like the passive indexation ETF type world has caught up with where the market is at. Now we've thrown in the options on top of that, and we end up kind of where we're at this inflection point where either we go into this total euphoric, there is no volatility in the foreseeable future of any kind, where indexation based on an algorithm at the end of the day at 3:30 between 2:47 and 4 o'clock every day, ETF index rebalancing takes place. And usually in the last 10 minutes of the day, you see momentum on the close and stuff like that. But these are actually, more than just momentum on the close. These are, brainless, no human emotion, just code that's just buying and selling based on formulations. That's fine until things go sideways. Now, when you look at the periods 18, you look at the period, the end of 18, beginning, end, and then 2020, you saw massive dislocations at the end of the day and at the beginning of the day. And those dislocations were between 3 and 4 o'clock, where you might shed 3% of the market because there's nobody at home, right? And there's no active management of any of that at all. And these are significant problems. So what happens now, right? So we're in this world where, volatility is back to an extent, but it has not even really become more pronounced in a period. We're still in these doom loops and nirvana cycles where it's straight down and then straight up. I believe that that's not something that's sustainable. And I don't think, and I'm not talking about it in like a very tactical perspective. My perspective on it is that, active managers have been thrown in the trash because there is no volatility. The last 2 years and a half, right, there's been sustained volatility for short periods of time, but that showed and exposed all the problems with the ETF infrastructure. And I think that's one of the reasons why you've seen this kind of hybrid semi-ETF that's popped up last year. And it popped up after March. And it's a half active, half passive ETF structure. And I think that that's going to be much more absorbed going forward. And so I think the ETF environment modifies because they've seen that that's not sustainable to have no one making any active management. And then I also think that you could have a total dynamic change in the market as it relates to the Fed put. And we've got to see how the new what could be a total Democratic slate in Washington, but even beyond that is I know that they've talked about the Fed. Even so, let's say there's not. Let's say that the Fed comes back to the Fed where they actually are talking about social equality, wealth inequality, racial inequality, all these different things that are polarization situations right now that'll come. They're going to try and participate in. That's not pro buy the dip. That's not the Fed put. That's a totally different ideology, a totally different perspective, and then we'll have a totally different profound impact on interest rates, which will have an impact on volatility. So I don't think that the period that we've experienced is, and I don't think in absolutes. So please don't think that I'm saying this in absolutes. Is that period that we've experienced for the last 12 years is less likely to be the next 3 years, 4 years, and it's already been trimmering the last couple years. And you are seeing the institutions move to that hybrid model, that semi-ETF, I call it. There's a couple names for them. But they became very popular last year after March. And I think that you're going to see more of that. And you're going to see somewhat of a return to active management. And we use our app, in our Explore search, it actually has a segment in there where you can compare mutual funds to ETFs, and mutual funds are actively managed for a lot of them still to this day, and ETFs are passive management. And the ETFs are outperformed by the mutual funds almost 75, 85% of the time, something like that. We have active versus passive where you can compare the ETFs and the mutual funds with just a couple clicks, and it'll compare all of them by sector. So sector lineups and the whole 9 yards, you don't have to do anything. And I think that's not even, you don't even hear about that. It's not discussed. ETFs are all on these do-it-yourself platforms. Nobody's buying mutual funds on these platforms. And so I think that, when volatility becomes when you could see, you have a bunch of different factors that could take place, and none of this has to take place, but I think it very much could, is that you've got the ETFs, which are innately kind of a dumb product, right? They just do what they're told, and they do what they're told based on the proxy of the documentation that they were created by. So they have a mandate, and they're going to buy or sell based off that mandate on that one time frame, regardless. Which is it does exacerbate the buy the dip type situation, because it's buy side, right? Rebalance and buy side. Well, when you see those things get displaced significantly in these periods of doom, then people are like, oh, I'm not sure about that. I'm not sure that product's sustainable in the long run. So people are already analyzing that, like Invesco and Spider and the rest of them. They're already looking at this hybrid model going, it's probably a little bit better, that we have some semblance of risk management around how the world is becoming much more volatile in these pockets of extreme volatility.
And also the time frame for the volatility occurring.
Correct.
I mean, we had a 33-day, 35% crash.
Yeah, and these things can't, and the mandates, like somebody had said something about it being an active manager, an allocator, but they were a mutual fund allocator, and then they were running an ETF, and they made a comment about it. I don't want to put the person's name or what have you, but there was like, last year was really tough because they couldn't change their mandate. They got crushed on the way down, and and the ETF got crushed on the way up because they couldn't catch back up because
the mechanical buying and selling that happens regardless of a 33-day, 35% drawdown.
Yeah, 33 days too fast.
But it's also a lot of funds have outperformed this year, right? And a lot of individuals have outperformed this year that came in, in March and just bought, Tesla on the lows and think that they're rocket scientists.
Well, you have.
So why would they settle for the S&P return when they can have, whether it be, 88% of assets outperformed this year. So if you were a gold bull, you were brilliant. If you were a tech bull, you were brilliant. You were a biotech bull. It doesn't really, unless you were, holding just dollars.
I think that all those are other composite factors. My whole take on it is what was pretty solid from the vol suppression environment, that the ETFs were really the vehicle of choice, and they grew way too much. Like 206 different ETFs own Apple, but they don't even own Apple. They own the rights to the securities of Apple. And so there's a lot of under the surface kind of murkiness to the way the ETFs are structured, that really, when these doom loops happen, we get these periods of displaced volatility, like your stuff calculates and sees these offsides moments, these things just get destroyed. And they're risky from a pension standpoint. Now, everybody's dealt with it, right? And they've, we salvaged them, but what it's taken to salvage these displacements is not something I think anybody wants to do, including the Fed. And so, now the active manager just almost, I think by default, comes back into play, that you have what could be a totally different regime, right? And then everybody's got to sort themselves back out again. And I think the biggest tell on that was that hybrid model that started showing itself after March of last year, where
show a few examples of those, because the hybrid model is, the Berkshire Hathaways that know how to use puts, right? There's
actually there's ETFs now that are being semi-run instead of that one time frame, right? Like, instead of Cambria is doing stuff like this, like Cambria is a group that's doing they have one called Tail. It's a downside one, right?
Oh, the Tail?
Yeah, Tail. So Tail is actually a S&P puts, right, out of
the tail risk.
Puts, and 80 to 90% treasury. So it doesn't get licked as bad as the straight vol does, right, when you're buying the VIX, but it does provide tail risk type of protection, and that's actively managed. They're actively rotating those. There are people back there with systems and so forth.
There's an ETF, RPAR, which is risk parity.
Yeah, exactly. So there are these hybrid kind of models that are starting to show up, that are not just blanket blind robo ETFs that have no ability to make any kind of discriminate decision in periods of displacement. And I think that anybody that the Fed put fine, okay, but when we're at the kind of towards the tail end of that whole cycle, and this is looking at it very long term, we're talking about 12-year period here, is that you begin to see different things form. And where the oscillation and volatility in the last 24 to 36 months is not something that these products are sustainable, with. So unless you get a total period of just more nirvana, right, that runs for 2 or 3 years, these products will be suspect to being kind of maybe crushed to an extent, and we start to see something new. I mean, it was before, it was ETFs were a new thing, 10, 15 years ago. And then they start to take off. Like SPY has data going back to like 05, right, 06, something to that effect. And and that, but what about before that? These are new. So we go through like these 10, 15-year cycles.
It's also going to help that we have had a cyclical value rotation in the past 2 months. It's also helped by IMF coming out today and saying we're going to have a lost decade. We're not going to have these outsized returns. It's going to be muted globally. Central banks have increased, their balance sheets to 50% of GDP. The top 10 central banks have increased their balance sheets to 50% of global of GDP. That is a lot of debt. And there is a diminishing, rate of return, if you will, on that experiment. So their call was the next 10 years are going to be really hard pressed to move significantly higher. Now, of course, you're going to get the bull case, which is what lower for longer in rates is going to continue to give, the support and the Fed put, and then of course, all this fiscal infusion that's supposed to be coming. And tomorrow we might get a little bit better clarity about that. But we'll see, right? So the Dems still need, Republican support there to get their 60 votes to get any stimulus passed and to really get moving that infrastructure and all the other policies that they're talking about right now. So there's still a lot of doubt that, I should say there isn't a lot of doubt in the market. The market's bid it up. But let's just say pragmatists, I think, are probably waiting for proof.
Yeah, and I know that typically it's harder to picture these types of things in environments like this where it's like, it doesn't seem to really matter at this point in time. It's typically about the time that it's already starting to matter. And I go back to you usually follow the banks and the institutions, and they started to really, and that's where I got tipped off on that stuff last year. Kind of in the middle of the year.
You mean, the hybrid ETF?
Yeah, and some people had sent me, what do you think about this? And I was like, I haven't really seen that before. But it makes a lot of sense that these things are out there, and you're starting to see more of that. And it's easier to make these types of structures, and that's becoming easier. And like even and I would say like Cathie Wood's success is very much the beginnings of that kind of story where that's really active. Like it's passive, but
they trade every day.
Every day. That's a discretion.
That's a day trading desk.
Yeah, and so I think that is more of the future, and that has nothing to do. This has nothing to do with like market ups and down calls, right? This has nothing to do with that. This is all about just kind of a big premise that was writing about related to that stuff, exactly like ARK, right? Where people, because of the access that everybody has, and it kind of leads into the SPAC conversation, because I know you're going to go there in a minute, is that, there's a lot of new things happening with the market that don't fit into these boxes.
Yeah.
So there's going to be a lot of, that's all active. That's all people that are jumping into the market in these different ways. And there's not a one size fits all box. Now, there's like, oh, this is what happened in 2000 and stuff like that with the market getting euphoric. Yes and no. The market is being way more participated in than ever before.
Absolutely. And options are exploding. CME just gave out 63% year over year increase in derivatives trading.
Yeah, completely. So I think that there's a lot of this different factors, like you see in crypto, the explosiveness in crypto, that's got to settle in somewhere in the next few years as to the actual, total use case, and how's the government going to involve in that, and et cetera. That's a whole new space. You've got
That's a whole new religion.
yeah,
I call it the old gods and the new gods, if anyone's
yeah,
watched Game of Thrones.
yeah, right, right. What's the protectors of the seven kingdoms, right?
Seriously, this is like, that's going to, anyway, the gold, old gold, new gold, but it's still, it's a place of worship.
Yeah, so I think that the ETF structure is very much a part of the doom loop structure and the nirvana structure, because it's a very indiscriminate situation. And I think that that is trying to be, naturally addressed by the market. Not just the Fed or, this person or that person, by the market as a whole. You're seeing different groups begin to take a different approach to that. So I think that that's a big thing. And I think that active management with a potential regime change and what the Fed's mandate becomes would be significantly interesting to see how that shakes out. Because if volatility becomes more commonplace, because we have pushed all the volatility into the 2020s, all the volatility in the 2010s was pushed to the 2020s. You can't eliminate volatility, you just move it. And so it's all been pushed forward, which we're now here now. It's like the COVID thing. We've got the vaccine, but they can't execute the delivery of the vaccine, and they don't have the ability to ensure that all the people are being, inoculated, and it's really struggling. And that's pushed. Okay, we push the problem forward, right? And so that is, now we're dealing with it here. It's 2021. Everybody's like, where is it? I want to get it. And I think that these things are no different in the market than in the real world. That when you do push stuff forward, at some point you go forward and then it's there. And so I think that that's kind of another straw on that cap, that active management is the thing that has to take place when there is very difficult, when you've got changes intraday that are, like your indicator that you've created, right? That's
which one? Because I got three.
The risk range, right?
Yep, okay.
Where it's changing every 30 minutes. Like that's not something that an ETF type basic rule structure from a code language is that they are struggling with that, and they get torched in these cycles. Like they get just really blown to smithereens, and they get really pinpointed, and everybody knows where their orders go in, and they just get wiped out. And those things don't play. It's like bringing a knife to a gunfight. So if you have a period of let's just say normalized volatility in the 2020s, not high, like just normalized volatility, those products struggle, and active management comes back in a little bit. And I think mutual funds and stuff like that, which are like that active strategy that was only in a mutual fund, like guys that I talked to, Catalyst out of New York. Those guys have run a long short futures ETF hedge fund, so long ETFs, short futures forever, and they've done a great job, Milburn. And that they created an ETF for that, right? And so it mirrored it, right? You're going to see more of that. That was new year or two ago. You see more of that where I'm doing an active strategy and it's active and you're available in an ETF. I think that those things do better. Like the whole active participant comes back into play. I think that blindly buying has never worked for a prolonged period of time in history, now long enough history. And I think that is, we're coming to the end of that. Like it may, okay, another week or two. Like look at yesterday as an example. Up and they came in and bang, it was no reason to be buying yesterday. That was it was on sale. Now, whether it be buying today, and that was nothing everybody was buy side allocations, and the whole CFA, RIA space, with the way that their desks work, they're all trading the ETFs too.
But at the same time, you have January, which is a really big impulse of buying in, first of the year. January has big inflows for pensions and such, assets under management. January, when they do their buying. So it's huge, and it's up big this year compared to prior. So, because they've got more money to put into it. We're going to have a bid, if you will. Most likely, that has been my contention anyway, through January. We've got to get through, obviously, this little hiccup and a little fear mongering, if you will, with the 5th and the 6th events. But ultimately, the 20th inauguration, and then what? So January typically is a good buying month.
Yeah, stuff comes in like from a volume standpoint, for sure, volume of dollars. I just think that, set it aside, for the year. I think that we're at the point where we're having to now deal with all these things, right? We're going to have to deal with the vaccine situation, which, I think the Pfizer thing came out yesterday. It said it's good for 21 days or something like that. We're not sure, and these are all like, okay, it sounded great in concept, let's execute. And in business, that's always the big thing, is the execution. So the markets have kicked everything into 21. The period, let's say that this is just normalized buying in January, that suffocates out any type of the underlying issues that remain.
But then they're done.
Then let's see. Then where are we at, right? And are we dealing with any of these execution issues are significant? And so now we've got to see what happens, right? And now, I think active management has to come back into play.
So we talk about this from headlines to macro to the day trading that's absolutely driving single stock gamma option flow in certain names, and they definitely rotate. Whether it be the Teslas and then the EV plays, the SPACs, the IPOs. There's no question. There's tons of and lots of new players in the market. 200% year-over-year increase in brokerage accounts, and option flow has exploded 63% year-over-year, according to CME yesterday. So there's no lack of new participants, and they want better returns than what the S&P, even though it's phenomenal, heavily big tech weighting. I'm just fascinated, this whole structure that we always talk about and the reasons for what's moving, right? More to the point, why it's moving. I just think psychology is people want to kind of get in there early and take advantage of these outsized gains, that the indices are boring and they're not moving very much, and they're really been going sideways. And yet there's been this incredible ability to seize opportunities this year that they think they can do better. And the downdrafts are so violent and sudden, but then they get bought. So they think they can just stick it out, and psychology is going to drive this rotation also into the hybrids because they're outperforming.
Yeah, I mean, theoretically, they're probably going to structurally, from a market structure standpoint, because it should do better on the down, and then to take more opportunistic risk on the upside. I'm still kind of very on the fence as to I would like to see what happens with the policy lineup for the regime change that's taken place in Washington. So what's the policy going to be? Everybody's like, oh, it's bullish. I get, okay. What is specific?
They always price in the best
case scenario. The Fed side of that, because I was talking this weekend to some folks, and it's like we don't have much central perspective in any way in life right now. And the policymakers are trying to work with that, right? We've got really far right, really far left, really wealth this way, wealth that way. They're going, we gotta get this thing kind of centralized again. Who gets sacrificed? Because nobody's going to be happy in that. And so I think, do equities get sacrificed? Equities have been the beneficiary. Do equities get sacrificed for some sort of other initiative? I think that definitely is on the table. I don't know that
it's a simple head count.
Yep.
Do they have 60 to pass or not?
Yeah, so we'll see.
And they're going to need, a few Republicans to come across the aisle. Will that happen or not? And we have, forget bifurcated market of Main Street versus Wall Street, and the political situation. Is it really going to change? We still have McConnell and Pelosi, and we still have, even if the House, increases, we still need that 60 count, that 60 vote count to get anything done, substantive done. So I know the market's already, bid this Biden win 2 months in advance. We talked about that. And obviously infrastructure and stimulus checks but they still need the votes. So this is the risk that I think the market still hasn't priced in. And all of a sudden they'll realize, oh yeah, that's right. We may not have any change. And then it's going to have to resort to, do we have the earnings growth? Do we have the continued weakness in the dollar? What if the dollar stops being weak? So what if yields do pop a little bit, although I'm not expecting significant, I think it's going to be whack-a-mole as it relates to any higher yields are going to, get defended, if you will. So it's going to put a cap on that value rotation. It'll still do well relatively, but I don't think it's going to, be a huge outperformer. So I think folks are looking for the outperformance. So the hybrid ETFs, the SPACs, which is why I'm doing that, the
yeah,
webinar.
I'm really looking forward to that. That's
because
great.
What the heck is all this euphoria around it when there's just not a lot of visibility into it? So those who are in the know or drink the Kool-Aid, depending on how you look at it, they're just momentum traders or they actually really know it. Craig happens to really know it. He's been trading it since 2007. So, but that insight of combining momentum with a new vehicle, which is all shiny. You got Bitcoin, of course, now it's Ethereum. Let's see if that takes off like hot fire flames. But the point is, I think value is still a great place for active management that feeds into your hybrid ETF. And then, of course, all the risk parity and the tail, ETFs that come and provide that ballast to a tech-only portfolio. Or the ARCs of the world who have gotten an infusion of money that is second to Vanguard. I mean, whoever thought that they would have a contender, right? So there's greed is alive and well. Speculation is alive and well, and when it starts to leave the building, we'll worry. But Tesla hasn't, missed a beat. And the market is still rallying on expectation that we're going to have a rainbow for the vaccine rainbow. Commodities will continue to be in demand because they have been, multi-decade lows. Yields will stay somehow magically suppressed, but not go zero. I mean, go negative. It's just basically the price to perfection across the board. I just don't see.
I think it's very hard to tag that much to that, right? Much more than that, I should say. That, I mean, everything is up. Everything. What, 88%, right? Something.
Yeah, asset classes are.
Yeah. I don't. And then you look at the actual, like, some of our guys are in London. And talking to them this morning, and that's don't even go outside.
It's their lockdown. That's right. The nation is on a lockdown.
Total lockdown. Like, if you go outside, it's for one time for exercise, and then or grocery store, and they stop you. Like, they're stopping you, right? And like these things, that's not perfection. Yeah, and I think that you could think that this is like just temporary. How many times is it going to be temporary? Right? Like, and so I think that the underlying sense of everything is that it's all based on a premise of belief.
Absolutely. No, everything is that, right? Faith in the dollar, faith in the Fed, faith in the rule of law, faith in, US leading the charge of, innovation and et cetera. But some have been tested, and we had that big 33-day, 35% drawdown in February and March. But it was we had the intervention. That was really the whole crux of the matter, right? So $9 trillion later in global liquidity racing through the veins and of the markets, global markets, and now a vaccine supposedly going to be racing through the veins. Although I don't know if you saw. France, they did a poll and they're like, nope, we're out. we're not taking it. Like a national poll said, yeah, we're going to see what side effects you got going before we actually jump in that line.
Anecdotally, here in Florida, no doctors and stuff like that. Like, they are having a hard time getting it. Like, it's
getting it, or okay,
versus, like getting a hold of it versus like actually, there's an appetite for people to take it.
Oh, yeah.
The people are genuinely, open-minded for the bulk of participants, and they can't execute it. And that's where I go, like, all this is all premise, right? Where everything is on a premise right now, or some perspective that now everything is on that. that's why I say maybe we look at targets, right? Target dates that could change perspective, or is there nothing that changes perspective at this point? And it's just this, it's the size of the market itself that begins to, you know, provide some illiquidity to the situation from a market structure standpoint. Those are the big things that I'm looking at right now, just personally, right? Is that, you know, what is it that would slow any of that perspective down? Or what is it that it's a moment where it becomes common knowledge that, oh, you know, hey, like this is like kind of broken. And I've begun to hear it from people. So right now I don't know. I think, you know, people say, I don't know anybody that had COVID. Do you know anybody? And at this point, I think I've got like, I don't know anybody that doesn't have it or didn't have it, you know, and in my, like, you know, close family structure, you know, out of state and just friends and so forth. And so, you know, that's like, now they're like, oh, it has these long-term ramifications to me. I have had trouble breathing for several months now. That not to go down the COVID path, but it's a realization of after that it's tangible. It's here. It's something. It's actually that destroys that perception of nothing to it. That's, I think, the same thing that's a big question with the market. It's kind of my, you know, goes back to my thesis to active management, is that we're really on borrowed time in a longer perspective from the decade plus of, you know, that this is manipulatable. And you do have the specs, you have this fervor, you have the options, you have the market structure things that you need to keep this thing kind of moving. But at the same time, it becomes more vulnerable because of those things, because there's holes in the way that those things work and the way that the dealers can compound the problem onto the other side. And it's like I actually think that, and this is the first time that I've told people, like, you know, I was looking around this weekend and I was like, hey, you know, some of this stuff I'm not fully, like, you know, comprehending everything, like, you know, can process all of the different idiosyncratic potential volatility pockets that are there. And outside of sheer market liquidity, yeah, I can look at that all day. But like these other things seem to be very, very, very it's elusive. Like I think you and I talked the other day. It was like it just is a little. This is tough. This is a tough little environment.
Well, it's very greed fueled, and that's what makes a market keep going higher, is the speculation. And yes, great, you know, panelist guest question. Next time the market plunges, will investors have faith that the Fed can save the day? You know, certainly seems that crypto emerging as a force and held by those who have lost faith. That's part of it. You know, that's definitely the gold bulls, whether they be the old or the new gods, see that as a hedge, no question. And that's interesting that crypto has taken off so strongly. And market, though, is still rising with it. They can also go down together, and that's happened before. That parallel, bonds and stocks can also go down together. That's happened in parallel. And it's kind of interesting because just recently, the last day or two, you know, there was this intervention by regulators to, you know, regulate, to, you know, to introduce, if you will, their own digital currency. So will that quell the excitement over crypto? Probably not, but there is definitely that movement. Yeah, watching liquidity, because right now the whole faith of liquidity still being in the market. Any talk of tapering is laughed at. I've been talking about Fed heads recently, yesterday and today. Any talk of raising rates, you know, in the future are laughed at. So the reality is we just have unprecedented debt. It is deflationary, and any of this build up higher in, you know, inflation expectations is helping the value trade, is helping the gold, you know, trade. But it is really interesting to see Bitcoin win above all others. And how much of that is lack of faith in our government, and how much of that is just as a shiny new thing and everyone's going after its momentum.
I would look at the Bitcoin piece as a multi-pronged thing. It trades 24/7, 365. It is the choice of the Z's and the millennials. They were early adopters, and they are the most active traders at this point in time, right? From a retail standpoint. And I think that it's not just, I think some folks say the freedom thing and all that, like, you know, come on, you're writing it on a napkin. You got to jump drive. It's like you got to have electricity to have it. The freedom argument isn't the argument, right? It's not the freedom argument. And it's not the portability argument, because you have to have electricity and an internet connection to access this stuff. You can cold store it, what have you. So what is it? I think that it's a vehicle that's very more readily available than the market, trades more volatile than the market. And you know, what's better for people that just get into the market than something that they can mess with all day, every day, and they can access all day, every day, and people can earn commissions, right? Creating that transaction all day, every day. And so I think that this is as much a product of velocity as it is, because gold, like the gold contract is futures, right? The gold contract is Sunday, right? Sunday night through Friday. Gold bars, you got to take them to the pawn shop or the gold distributor and, you know, exchange. And it's not easy. It's really illiquid. You know, you're paying less or more than you buy. You know, you got to be a long-term holder of the physical stuff. And so then your ETFs, I think that Bitcoin is just more liquid. It's on, you know, Robinhood and most of the free apps. That's one of the highlighted trading things. So, you know, I think that, and they allow fractional trading of it, and much more fractional trading of it than has just been created for Amazon and so forth. So I think it's an early adopted. I think it's just highly liquid situation in a finite market.
And yet it's very, I have to comment because I tweeted this on the 31st regarding Bitcoin that I didn't know. I thought it was fascinating, but it was a chart in Bloomberg that I grabbed. You know the percentage of accounts that own 95% of the Bitcoin supply?
Oh yeah, it's
Two.
Yeah, go for it.
2% of accounts own 95% of the supply.
Yeah. And they bought it in 2012, 2013.
But the point is that's scarce, you know, resource, quote unquote. But I love the conversations because I'm not an expert. I don't even want to try to be one.
I don't dig into it. I don't even dig into it.
And yet we have to talk about it because it is the best producing asset class. And I actually just put that in chat, which was sent by Craig, a client of mine. And it was a great article. And it basically said, where was this? Yeah, I just did it. The year of speed chess and Bitcoin as an asset class. It's a great article. So
is it, you know, things take you, it depends on, I don't look at the, I was talking to somebody the other day, is like blockchain itself. There's a lot of things that this you know, dispersed database concept could really rectify or help rectify property appraisal type stuff, real estate transactions, you know, DMV type stuff. Well, there's so many applications to the you know, the dispersed database and where everybody works into it.
And that's why it was initially set up. I mean, my understanding is it was a payment system to avoid the fragile banks. It wasn't necessarily a testimonial against central banks.
It's not a coin, right? That's what I just said is not a coin, right? A coin is a tulip, is a gold bar. It's a perception. And so I think that, you know, that perception in the coin right now is substantively different than maybe the underlying. And I apply the internet from 1995 to 2005 and the dramatic changes that made. There was these bubble type bids in different things, pets.com, et cetera. These types of companies are worthless, coins that are worthless, right? That, like, you know, all these types of alt things and so forth. That's not, that means money's coming to the sector per se, but the things that will probably last in the long run will be the companies that adopt the actual technology that does provide an application to use cases in
transactions
existence that provide utility from one person to another. And I just don't see what that is with Bitcoin itself. You know, the guy wants to be paid half a Bitcoin and his salary,
$half.
NFL played $half. And then yet they're all measuring. I see measurements in TradingView and Robinhood and everything else. I see Bitcoin as measured in dollars. Well,
Absolutely. But
shouldn't
it's
it be
funny.
measured in dollars being measured in coins?
But we also know that speculation drives price. And if they see this as a, a fiat debasement strategy or tactic for hedging, and they see the dollar going down and Bitcoin going up, they're going, "Ooh, we need more of that."
Yeah, I mean, I'm not denying the gains, right? Or
Yep.
and I had said something like that this weekend, the appreciation in these things. So be it, right? Like that's great, and people should be kudos for trading that. But just acknowledge that you're trading, right? A vehicle is what you're trading a warrant for an oil company. You're just trying to make a profit, per se. You're not doing anything more than that. And that's why I say the long-term use case, and I'm really speaking long-term today at the beginning of the year, is that how tested are these things that are being substantively put a lot of weight onto, right? They're putting everything onto these things. People are putting all their money in these coins, and people are putting all their faith in this vaccine, and they're putting a lot of the it's 100% guaranteed that it takes to. And I saw people like saying, "Oh, I'm willing to lay my life down for Bitcoin," and I was really shaking my head this week, and I'm like, okay, like the believers or whatever, right? Like that's not like sustainable.
It's a place of worship. And
that's not sustainable in the long term. That is not a sustainable structure. And being in business for a couple decades now, if it's got a hole in it, at some point it will be exposed. Now, what that time frame is, you never know, but it always all is exposed. And so it's just a matter of time where we find out. And I think that when we find out, and I think there could be active management Bitcoin people, right?
There are.
I think that will grow because they'll need people to actually help them think through all the different things. And that's what I would look for as an investor right now. If it wasn't so high, right, I would be looking in that way. It's like, who's the best active allocator to this, right? How are they going to find me the best long-term applicable utility things to the human species, right? Those are the things that have always, through the course of our history as human beings, been the progress things that do end up being extremely valuable. Apple, Amazon, right? AT&T before that, right? We're doing a little piece on Claude Shannon and Thorpe that we're putting out for this week and next week. It's just like everybody go back and look at these stories of like what Shannon did for the comp sci and for the internet. Most people don't even know, right? These things have happened, and the utility creators, these vehicles that do create utility for us, are the things that are always rewarded in efficient markets in the long run, not things that are based on speculative gains, right? Or appreciation in a short-term environment. That is completely and utterly speculation.
But it's fun to go there and envision or predict, because no one last year, predicted this pull forward of e-commerce business the way that it transpired. No,
Totally.
That was on a nice, steady, then it went to hockey stick. So the talk of MMT was just ridiculous, and now it's commonplace, right? We're actually doing it in a way.
Oh, we're 100% doing it.
Yeah.
No,
so
not even in a way. We're doing it like full blown, doing it fiscal.
Bitcoin had a cult. Now it has an asset class. Now it's an asset class. Yeah. Did anyone ever expect negative oil? We had a hell of a year.
Yeah, no, 100%. And I think that comes into this year. Like you're going to see.
Like, what outrageous thing could we come up with and put down as a prediction? Because
I don't know, like higher and much lower, right? Like
Trump isn't leaving. That's fine.
Yeah. Okay. Right.
He's going to have his own encampment. There's going to be Camp David, and there's going to be Camp Mar-a-Lago, and he's going to have a ceremony on the 20th. Biden's going to be in DC, of course, and it's just going to be one of those like surreal parallel universes. I don't know. It's, to me, what possible prediction could we make for 2020, 21? I think it needs to be a decade prediction. Like IMF just came out and said, yeah, we're not going to have, whether or not you believe it. The point is, where is the traction in this estimate of looking forward. I see some great distribution moves of volatility and assets as we just keep going from this, sector of speculation, and they roll over to the oversold one, bring it up, go over to the next one. In the same way, tech has really been flatlined, for half a year. I mean, if you look at on a weekly, it's just been gyrating sideways while value's been trying to get up off the ground. It's just, these are fun sector rotation plays that I look for.
Oh,
But,
I think you're active management. You're an
I
example.
am. I look at Bitcoin and I'm like, what's next?
Right?
Ethereum looks really hot.
It's active management, right? And I think that becomes an environment of, and even though we're not having per se, we're a little bit of a period of prolonged VIX suppression, isn't the Bitcoin move just a vol move in the opposite direction? That's highly volatile move.
Oh, I hadn't thought about it that way.
That's volatility, and you're getting positive volatility and negative volatility. It's not like that you're not seeing already just ramp. I mean, look at the move from Bitcoin. It's like October to now. It was at 8,000, 9,000, I think, at some point in low. Don't quote me on that, but somewhere in there.
Lower. Yeah.
Done all this in 8 to 10 weeks. Whether that's a down move or an up move, those are volatile situations. And you can't sit there and you go, okay, well, only because it goes up, it's not volatile, right? It doesn't mean anything at all. That doesn't mean anything. That means it's simply just as volatile, just in the opposite deviation. These are standard deviations that are crazy. And I've seen the stock to flow model and all that kind of stuff, but it's still crazy standard deviation moves. And you're seeing some of that in these SPACs and some of this other stuff. That is volatility. And my expectation, and that's really an underlying point of the active management, because systems bots can't pick that. You can pick that. People can pick that. And you're seeing that with like the Robinhood folks that are moving from green to green to green, is that they are tracking that. And it's like a simple thing to look at. Now, the problem is that's an easier thing to do, buy and hold, because you can go to sleep. But we've talked about this several times. Selling is difficult, right? And selling the opposite side is very difficult. I think my prediction is this year, we got to find out the efficacy of these new structures that we've developed in the last 12 months. This year, we need to find out what those are. Are those going to be long-term things? Are these new long-term situations where people can just as well learn how to do the opposite? They just as well can rotate and do this other stuff? Or is this just another period where, it's the same story, different day, right? And I don't have a prediction on that. I just think
it feels very different to me that there is just a lot of pent-up demand to demand returns, and they're going to go find it come hell or high water. It's just,
well, think about
they gather together. They gather together in community. This exchange is so quick and intense. I mean, you've talked about the millennials and the Z's that have this Discord and they're whatever, they're tightly connected and rapid fire in their connection of just jumping on with total confidence, whether they know what they're doing or not. It's phenomenal to watch. There's really some fast action going on here.
I think that the gamification of society.
That's a great word, gamification.
Gamification of the things that may have been challenging is the story of the decade. And so
I love that. Gamification. I'm stealing that.
Yeah, go for it. Go for it. I didn't make it up. That's a dictionary.com word right there. We're seeing already things with schooling that have happened in the last 9 months, where challenging subjects are now retaught in a different way, illustrations and storybooks for medical school, right? Fascinating things that are taking place at that schooling level. That is a total change of the paradigm. I go back to the internet of 2000 time frame. Is that was something that a lot of stuff got bit up, but the underlying change was so great that it just created a massive impact in the next 20 years. I think that this is not dissimilar but just a different type of thing with some different mechanics going on. The changes that are taking place, like, you know, like we've talked about, like a Roblox type environment where you've got people creating stuff all over the world and distributing it to each other. Substack success this past year is incredible. These are all things to me that are pro-SPAC, proactive management, because they're not coming in the market. They'll come through a passive route, like Chamath doing 26 A, B, C, D, E, F, SPACs, right? Like he's bringing to market different things. One of them is the housing one that is going to eat the real estate agents up, right? And these are speculative things, but these are things that should take place. The efficacy is the bid in line with the underlying actual utility that's being provided. And I think right now the bid is significantly out of line with the underlying utility, but the underlying utility is in an uptrend from this stuff. This isn't an uptrend. So like all these things that are being created, the utility that's being created for us that's skipping steps is in an uptrend. But the price right now, I can't bid on some of this stuff because it's so different. It's like it's so high. You're chasing it, but you better have stuff. If you can,
then you are not drinking the Kool-Aid. Let me share something with you real quick.
I will. I'm super interested in this. I'm super interested in this thing on Thursday because, like, look, I'm one person, couple people, team members, and so forth, right? Everybody's always looking for maybe the people that you can allocate capital to, that have ideas, that have different things, that are in different targeted sectors, that have a better edge on the knowledge bases going on. I'm talking to a couple gaming people right now.
Yep.
Electronic gaming, I think, is totally going to be a massive space. And I think
the skills that it imparts, which is, you know, ADD and ADHD to the extreme. But let me just comment real quick. This Chamath,
I saw this earlier. Great,
celebrity, you know, CEO and SPAC maker and such. All he sees is perfect price, perfect pitch, perfect opportunities to make more money. This is perfectly positioned no matter what, right? So the Dems win Georgia, Senate passes 2K stimulus, assets keep inflating, or Republicans win Georgia, Fed continues to pump money into stock and bond markets, assets keep inflating. It's a win-win scenario, right? So that's his pitch deck.
Yeah,
and that's his pitch deck right there. And I wrote, it was kind of funny. You saw the Monopoly reference. And I said, it's all Monopoly money anyway. But the funny thing was, I didn't realize it's been since I was 8 and played Monopoly. And a client sent me this and said, you know what, if you run out of Monopoly money, you're just going to write some more little pieces of paper that you owe it. And I'm like, oh my God, I forgot that detail. But the point is, we don't run out of the Monopoly money. And yet this little piece popped up and I grabbed it to show to clients also in this chat where Peter mentioned it's astoundingly high debt levels and the ongoing Fed purchases and intervention at some point will not have the intended effect. Because look at how this is getting condensed, right? And by the way, Monopoly, you gotta look at this. Started in 1904. Anyway, the amount of this M1 acceleration is talking here about the time compression. You know, it just gets tighter and tighter and tighter as it relates to this velocity of money. Where are we going with this? We're just 4 months. We had the $6 trillion, 7th trillion is just getting compressed tighter and tighter and tighter into this kind of like parabolic blow off. That's what it feels like.
I think Chris Cole's comment about the chaotic neutral that you brought up last week, and I think the right tail, left tail of inflation, you know, we're obviously taking the hyper inflation side, right? They're siding with that type of environment. That still goes back to my comment about execution versus perception, or, you know, concept. Concept is different than execution. And so now we're going to come to the time where these things have to be executed upon. Their thesis, negative interest rates, is a thesis, right? That it works, right? And that everything, we've got this deflation of technology and debt They both are deflationary, but we're accommodating that with the surplus of monetization thesis, right? So now we're kind of coming towards the conclusion of that period. I'd like to see personally, before I go put significant 10-year perspective out, like if I was talking to financial advisors, like, what do you want to do for the next 10 years? I need to see, like, you can be long, but with a stop, but I need to see what happens at that time when we find out whether these things are more than a thesis. And last March, December before that, March before that, all of that stuff was like, whoa, go to the default, throw the bag at it. They probably are looking at two more bag opportunities before we find out whether crypto really is the answer, or whether there is some other answer, or whether this experiment has gone bad. I have said the word experiment for a while now. This is an experiment. Like, it's totally an experiment. There's so much capital was created in the last 6 months that it feels like an experiment in a lot of different areas. So I personally would like to see how some of this stuff shakes out. As when I was 22, right, it's all upside. When I was 32, I'd seen business stuff go sideways, and people, they lie, right? They do this, or maybe they're doing something for a different reason.
Math lies too, though.
Math can be bent, right? But what doesn't is physics, and just the sheer natural cycles of everything, and the cycles of how much we can absorb, right, at any given time as we progress, right?
But timing that is always,
I think you're going to have to see. Yeah, you're going to have to see. This year should be much more. That last year was a beginning. We're in it. We're in this tumultuousness, this fourth turning, right? As Neil Howe so calls it, with these fourth generational changes that go back in history. So we're in it, but what all does it mean, and how does it shake out? And I think that we don't know enough, and we're going to be seeing stuff every month this year too. I don't think that it's like I told you, like China took the week off, 2 weeks off for the U.S. holidays, and we come back and Jack's disappeared. So this stuff nothing's set aside, nothing's stopped. Everything, all the volatile components that can still pop up are there. We got to let them play out a little bit, and I think that. There is an active, to the trophy goes the ability to navigate the different twists and turns that all that will be in 21 and 22 and 23. I don't think that you're going to be able to just buy and hold from right here through 23. That I would be bold enough to say that. I think you might get washed out a couple of times.
I have to reference this before we go, which is Blast from the Past. We were talking about ARKK, obviously Kathy Wood, and it's been a phenomenal performer, and it's totally in the forefront of all the speculative sector rotation plays, from AI to EV to just you name it. But I love this. I grabbed from, again, Twitter. If this is like 2000, then the ARK ETF is the new Janus 20, and there were the holdings obviously back then with the write up to accompany it. I expect that with time and patience, these companies will grow into their valuations. And that's, to me, what it feels very much like. We've pulled forward so much, and we kind of like end this call as we go into earnings season, right? We're now starting to go in and look at and listen to the conference calls with Q4. How they actually guide will actually matter. And how much of this, to me, is going to be, let's just say, tested. We've got earnings coming up. This growth has been pulled forward. Earnings growth matters. If we don't have the 60 votes, let's just say, that the Dems need to get stimulus passed, what else is going to keep this market levitating? Speculation needs some good numbers coming in and strong guidance. So we'll see what happens. It's starting very, very soon. But in the meantime,
go ahead.
No, go ahead.
I was going to say the thing that I would leave with is, did you see the L3 story that somebody put together this weekend? The story of L3 Communications from
No,
Witt and Berkshire Hathaway back around 2000.
no, I
And
didn't see that.
basically, it was a reminiscent of Bitcoin. Everyone wanted to get a hold of L3. Everyone in Omaha had a share. Everybody was paying each other, paying the electrician, paying the plumber, and shares of L3, because they had changed telecom, right? They were supposedly going to change telecom. And Kiewit, the head guy at Kiewit Construction, was kind of like an anointed guy. He always was successful with everything he did. Buffett got behind him the whole 9 yards. And that whole thing, L3, from peak to trough, was 90+% loss, and
Wow.
destroyed multiple billions of dollars in family household wealth just in the suburbs of Omaha. And I'd never really heard that story before, and I read it this weekend, and it was not dissimilar. Telecom did change everything. Cellular and wireless changed everything. But what happened was L3 was behind the existing conglomerates of AT&T and several others at the time, and they just got napalmed when it came time to do that. So I think that, a lot of this perception is priced beyond perfection to what you're stating, right? It's totally, you're dead right. It just, so when does that come to have to be tested? When is that tested? And I don't know that. I don't know that. We'll see.
Timing's the hard part. Well, we're going to end this and say thank you again for showing up on Tuesday for our first chat with Jonathan for the year. And market structure is still obviously grinding higher. Volatility gave us a little reminder of complacency on Monday. But ultimately, we're going to get through the Electoral College count and the Georgia call tomorrow, likely, if it's not contested in court, which it probably will be. But in the meantime, this Thursday, I have got a webinar with Sang Lucci. We're doing another talk, Women in Trading and Finance, and we're going to have Sassy Options. I don't know if you're familiar with her, but she has been around for a while. And oops, let me just get her. Rachel Sasha, for those who might know her from Option Land. And then next Thursday is when I'm doing the SPAC talk with my, I've got Tuesday. Hold on, that's the wrong one. I'll get it. There we go. This is Craig. So this is a trader of SPACs for a while. He's actually been doing investment management since 1998 and SPACs specifically since 2007. So he is just all about that. He's made a fortune this past year in that space alone, but there's a lot of granularity to that, units and warrants and stock. Oh my. So he's going to kind of run through that. That's next Thursday. So I think that's it. This is this coming Thursday and we're out. Sign up if you want to get a copy of this. It will be posted on my YouTube channel and Jonathan's as well at Big Tech. We didn't talk about the indicators, but there's more time for that. We're going to fine tune those anyway, as far as user interface, and start doing the beta testing with clients before we actually get that announced. But they are going to be very cool. Can't wait. We'll talk about that more another time.
Absolutely. Absolutely.
Thank you, everyone. Yes, thank you. Happy New Year. Bye.
Yep. Bye.